Hey, what's going on, guys? Welcome back to the channel. In today's video, we're going to be talking about one of the most popular ways to generate passive income, which is through dividend investing. Throughout the video, we'll talk about what a dividend is, go through some pros and cons to this type of investing. I'll give you some tips on how to identify the best dividend stocks. And then at the end of the video, I'll share some stock ideas that you could potentially invest in. So if you guys are new here, hit that subscribe button and please leave a like if you do find any value throughout this video. So dividend investing is one of the most popular ways to invest your money in the stock market. And even though it can be a great way to make some extra money on the side by really just doing nothing, there are a few downsides that you should take into consideration before you do buy any stocks that pay dividends. So for those of you who are completely new to this, let's just start off by going over what a dividend is and the major advantages that come along with this type of investing. So when you invest in a stock that pays dividends, the company is essentially paying you every single year just to hold on to their stock. And this is great for both the company and the investor, because for the company, when they offer dividend payments, this will bring in a ton of new investors. And from the investor's perspective, well, who doesn't want to make extra money to just hold on to a stock? When a company offers dividends, they will pay you a set amount of money, which is also referred to as their dividend yield. And this is based on how much money you have invested in the stock. So for example, if we look at Pfizer, their dividend that they pay out to their shareholders every year is $1.56, or a 4.3% yield. And this is for the year, but generally dividends are paid out on a quarterly basis, meaning that you would take that amount, divide it by 4, and then it would be paid out to you every 3 months. So this means that for every share of the stock that you own, you'll be paid $1.56. So say you had 100 shares of the stock, you'll receive a dividend payment of $156 every single year just for holding the stock. And even though this might not seem like a lot of money, you just have to remember that this is 100% passive income, and you'll also be making money on top of this when the stock price rises. So normally when you own a stock, there's only one way to make money, and that's if the stock price increases. But if you are investing in stocks that pay dividends, you'll be able to make money when the stock price rises. And you'll also have a stable form of side income through these dividend payments, no matter what the market conditions are like. This is what attracts a lot of investors into this space. If we are in a bear market and your investments are losing their value, at least if you're invested in stocks that pay dividends, you'll still be making money every single quarter from these dividend payments, even if the stock price is down. So this all sounds pretty awesome, right? You're literally just making money by doing nothing, and you can do the math, but when you do have a lot of money in these companies, say a few hundred shares or a few thousand shares, you can imagine how rewarding this can be, and you're pretty much just making a stable side income from just buying stocks and letting that money work for you. This is the end goal for a lot of investors, to one day have enough capital to invest in dividend stocks so that they can just keep their money invested and then live off of those investments and all the dividends that they receive every quarter. So this all sounds great, but there are some downsides, so let's jump into some of those right now. And the first downside that people don't like talking about is that companies can really cut their dividends at any time. And even though this is not in the best interest for the company, it does happen time to time, and it can be a problem for anybody who's 100% relying on dividend income to pay bills every month. There's no official contract or anything that says a company has to pay you a specific dividend. If the company does go through a rough patch and has a few tough quarters, they can cut their dividend, which will result in you receiving less money than you initially thought, and there's really nothing you can do about it. So if you are 100% invested and relying on just one company because of their dividends, this might not end well, and I'll get into a little more of this in a bit, but there's a lot that you need to take into consideration when you do buy dividend stocks other than their dividend yield. So this is why you need to look for companies that have a very strong track record of not only paying their dividends every year, but keeping them steady and even raising them over the years. When the majority of investors look for dividend stocks to invest in, their main focus is that dividend yield, or how much money they're going to be paid based on the amount of money they have invested in the company or the amount of shares they have. But this actually is not the way to go about it. And just so you know, a lot of companies that do end up cutting their dividend are these companies that start off paying an extremely high yield. At first glance, if you see a stock that pays a 3% dividend yield and then one that pays a 9% dividend yield, you're naturally going to be attracted to the one that pays 9. This is actually a big reason why people get caught up in these stocks that just can't maintain this steady payment. What you actually want to look for is a stable dividend yield, and a company that's going to be consistently profitable, which generally does mean a lower yield, somewhere between, say, 1 or 3%. So if you see a company that pays a massive 9% dividend or whatever it is, and you haven't even heard of this company, or it's just not a well-known stock, then it's probably too good to be true. Think about it like this. If a company pays out a very high dividend to their shareholders, they might just be getting rid of all their profits and not reinvesting any of this money into themselves to actually help grow the business. And there actually is something that you can look at to see exactly how much money a company is paying out through their dividends, and that's through something called a dividend payout ratio. So this shows you the percentage of their earnings that are then paid out to their shareholders through dividends, and you can find this through Yahoo Finance by just searching for a stock, clicking on statistics, and then scrolling down to the dividend information. A good number to look for here, or just an average number that investors tend to look for, is between, say, 30 and 60. If you see a company where the ratio is closer to 100 or even above 100, this tells you that they're nearly paying out all of their profits through dividends, which means they don't have money left over to reinvest in the business. So if this is the case, you'll likely see the stock price fall because the company just really isn't making any money at the end of the day. It might look great on paper because it does give off the idea that this company just has tons of money to pay back to their shareholders, but if a company pays a 9% dividend yield and the stock price falls 15% on the year, then you're actually losing money. So make sure you don't get caught up in these flashy dividend yield numbers because they might not be as good as they seem. Instead, what you want to focus on is the company first and look at how they've been growing / how they're projected to grow in the future. And then the dividend that they pay is really just an added bonus. If you can make money every year just on your investment and then have a stable form of passive income on the side through dividends, that's when you found a winner. And you can get a lot of dividend information just from the company's website. If you go on their website and look under their investor relations section, you can go on and look through their dividend history and all their dividend information, and then you can look at the specific info on how many years they've paid dividends, their increases and decreases, and everything like that. This is really the main point of the video. Don't focus too much on the high yield itself, because a lot of the times with a high yield comes high risk. So what you want to see is a good, stable yield with a strong history of dividend payments and increases and a very attractive dividend payout ratio. So this will all show you that the company will still be able to pay you their dividend that they promised, and they'll have money left over on the side to reinvest in the company, which will then help you even more because the business will grow and the stock price will rise. Some companies that fit this criteria would be something like JP Morgan with a 2.32% dividend yield and just under a 41% payout ratio. Home Depot with a 2.17 yield with a 50% ratio, Cisco with a 2.82% yield with a 60% payout ratio, and Intel with a 2.14 yield with a 26% ratio. So even though these companies might not have had the craziest yields, they averaged between 2 and 3%, which is very consistent. They also had a very good dividend payout ratio. And these are all companies that I'm sure you've heard about at some point, and companies that have shown steady growth over the years that will likely continue to grow. So with stocks like this, you'll not only have a consistent dividend income coming in, but you'll actually be able to make money on your investments over the years compared to these other companies that might just pump up their dividend yield to look good on paper, when in reality, they're actually just losing money every year. So best case scenario for dividend investors is having the stock price increase every year, as well as the dividend payments. So this is what you need to look for. You need to find companies that aren't going into crazy debt for just paying their dividends, and ones that have actually shown growth over the years. So there's a quick intro on how dividends work and some things that you should consider before you do invest in companies that pay dividends. If this video did help you guys out in any way, please leave a like and subscribe to the channel, and send this to someone who is looking to start generating passive income through this type of investing. I'll see you guys in the next one. Peace.